Hey folks, welcome to today's lecture on financial analysis techniques. We're diving deep into understanding how to convert raw financial data into meaningful insights. As future CFA charter holders, you'll need to master these techniques to evaluate a company's performance, assess risks, and make sound investment decisions. So, grab your coffee, buckle up, and let's get rolling. First off, let's talk about the financial analysis process. Think of this as the backbone of what you'll be doing as a financial analyst. The process starts with understanding the objective. You need to know why you're analyzing the data in the first place. Are you looking to assess the financial health of a company? Are you trying to value the company for a potential merger? Maybe you're assessing risk. Nail down that objective. Once you have the purpose, the next step is to clarify what you need to answer. This is where you select the techniques, like ratio analysis, trend analysis, or scenario analysis that are best suited to achieve your objective. And remember, there's no one size fits all here. You got to choose your tools based on the questions you're trying to answer. The framework generally includes several phases. 1. Articulate the purpose and context. Have a chat with your supervisor or client. Find out what they want and why they want it. Get all the guidelines, the timetable, and the resources sorted. 2. Collect the input data. You'll gather financial statements, have discussions with stakeholders, maybe even visit the company's site. 3rd is process the data. This is where the magic happens. Adjust the financial statements, create common size statements, ratios, graphs, whatever's needed to turn raw data into something useful. Then is analyze and interpret. Use the processed data to draw meaningful conclusions. 5. Develop and communicate conclusions. Write up that killer report, make your recommendations, and back them up with your analysis. 6th is follow-up. Keep the loop going. Compare actual performance with your forecasts and revise as needed. Today, we're zooming in on phases 3 and 4, processing and analyzing data. Ready to dig deeper? This process is all about turning data into decisions. Now, let's break down some of the tools in your financial analysis toolkit. We've got a few heavy hitters like ratio analysis, comparative financial statements, and common size analysis. Ratio analysis helps us strip away the fluff and size differences between companies. Whether we're comparing a giant like Apple to a smaller tech startup or evaluating a company's performance over different time periods, ratios are our go-to. Comparative financial statements include horizontal, trend, and vertical common size analyses. Horizontal analysis lets us compare the same financial statement over different periods. Think of it like looking at year-over-year growth. Vertical analysis, on the other hand, expresses every line item as a percentage of a base figure, like total assets or sales, helping us see what's growing faster or shrinking. Why do we use these tools? Well, they help us remove the size factor, making it easier to compare companies of different scales. For instance, ratios and common size statements allow us to compare a small tech startup with a multinational conglomerate. It's like comparing apples to apples, not apples to oranges. But hold on, what if we're dealing with companies that report in different currencies or have different fiscal year ends? For currencies, we can translate financial statements into a common currency using end-of-period exchange rates or average rates. If fiscal year ends differ, we might use trailing 12 months data to align the periods. And if there are differences in accounting standards, we'll need to adjust the statements accordingly. Makes sense so far? Awesome. When it comes to ratios, there's a whole universe out there. But remember, ratios are just tools. They need to be interpreted in context. Ratios can help us evaluate past performance, current financial health, and even predict future performance. But beware of the limitations too. Ratios don't always tell you why something happened, and they can be distorted by accounting policies or even manipulated data. Here's a quick example. If you're comparing two companies, one with high inventory turnover and another with low, don't jump to conclusions that one is necessarily better than the other. The company with lower turnover might be preparing for a big sales season or might have different credit policies. All right, team, we've seen how ratios can be pretty nifty tools in our financial analysis toolkit. But like any tool, they have their quirks and limitations. So let's dive into some of those, shall we? First up, heterogeneity. Imagine trying to compare a tech giant like Apple with a diversified conglomerate like GE. Apples to oranges, right? Companies operating in multiple industries can have ratios that are all over the map, making it tough to stack them up against industry averages. Then there's the lack of context. A single ratio is like a snapshot. It captures one moment but doesn't tell the whole story. It's like judging a book by its cover or a movie by its trailer. You might miss some crucial plot twists. Inconsistencies can also throw a wrench in the works. Different companies might calculate ratios differently. So when you're comparing ratios across companies, it's kind of like comparing a baseball player's batting average to a basketball player's shooting percentage, not exactly apples to apples. Speaking of definitions, there's no standard definition for many ratios. One analyst's quick ratio might not be the same as another's. It's a bit like regional slang. You say soda, I say pop. Interpretation challenges are another hurdle. Ratios don't come with a user's manual. They require judgment, nuance, and sometimes a bit of detective work. They're tools to guide us, not give us definitive answers. And let's not forget accounting differences. Companies might use different methods for valuing inventory or depreciating assets. It's like trying to compare temperatures when one thermometer is in Celsius and another is in Fahrenheit. There's also the potential for manipulation. If a company is, shall we say, creative with their accounting, the ratios will reflect that misinformation. Garbage in, garbage out, as they say. Another thing to keep in mind is the historical nature of ratios. They're based on past data, which doesn't always predict future performance. Just because a company was the star quarterback last season doesn't mean they'll avoid injuries this season. Lastly, determining target values can be tricky. Without proper context, it's tough to say what a good or bad ratio is. It's like asking, is 70 degrees warm? Well, it depends. Are we talking Fahrenheit or Celsius? Are we in Alaska or Arizona? We can compute ratios ourselves using financial statements or pull them from databases like Bloomberg. Just be cautious. Different sources might classify or calculate ratios differently, so always double check. Moving on, let's discuss common size financial statements. These are powerful tools for comparing companies and analyzing trends over time. By converting everything into percentages, we can easily see the composition and structure of the balance sheets and income statements. In a common size balance sheet, we express each item as a percentage of total assets. For the income statement, we express items as a percentage of total sales or revenues. For example, if we see that accounts receivable have increased from 10% to 15% of total assets, what could that mean? Maybe the company is selling more on credit. Perhaps they've loosened their credit policies. Could be that their collection efforts have become lax, or they might be using more aggressive revenue recognition policies. Horizontal analysis involves comparing financial statements across different periods. We're looking at the percentage increase or decrease of each item over time. Cross-sectional analysis, or comparing a company against its peers, and trend analysis, which looks at how a company's performance changes over time, are both key. Cross-sectional analysis is all about comparing our company to others, peers, industry averages, you name it. It removes size and currency differences, allowing for a fair comparison. Trend analysis. Here, we're examining our company's performance over time. Are revenues growing? Are expenses creeping up? It's particularly useful for stable, mature companies. Imagine you're looking at the tech sector. A company's revenue growing faster than its assets could indicate it's becoming more efficient. But if net income is growing even faster, it might mean they're cutting costs or benefiting from non-operating gains. Always dig deeper. Is this due to core operations or one-off items? All right, folks, now that we've got the basics down, let's talk about financial ratios and how we can use them to really understand a company's performance. You see, financial ratios are like the lenses of a pair of glasses. They help us see the financial health of a company more clearly, but there are different lenses for different purposes. So let's break down these financial ratios into 5 main categories. Think of these as the 5 core building blocks of financial analysis. Activity ratios are our first stop. These guys are all about how efficiently a company is managing its day-to-day operations. It's like asking, how well is the company using its assets? Are they keeping inventory levels just right? Are they collecting those accounts receivables on time? You want to see that a company isn't sitting on too much stock or letting money sit in receivables for too long. Next up, we have liquidity ratios. Now, these are all about a company's ability to meet its short-term obligations. Imagine you're running a business. How quickly can you convert assets to cash to pay the bills? Liquidity ratios help answer that question. Then we have solvency ratios. These look at the long-term picture and answer the question, can this company meet its long-term obligations? These ratios include leverage and long-term debt ratios, giving us insight into how much debt a company is using to fuel its growth. Our fourth category is profitability ratios. These are pretty self-explanatory. They measure the overall performance and profitability of a company. Are they making money or are they just scraping by? We'll look at how well a company turns its revenues into profits. Finally, we've got valuation ratios. These ratios help us understand the value of a company's assets or earnings associated with ownership. Think about it like this. If you own a piece of this company, what's that piece worth? Now, it's important to note that these categories aren't completely distinct from each other. They often overlap. For instance, activity ratios can also tell us about a company's liquidity because if you're collecting receivables faster, guess what? You've got more cash on hand. Similarly, some profitability ratios can hint at a firm's operating efficiency. So don't box these ratios into isolated categories. They're all interconnected, like parts of a big puzzle. Now, moving on to how we actually use these ratios. There are 2 main ways. 1, cross-sectional analysis. This involves comparing a company's ratios to those of its competitors. It's like a sports league. You're seeing how your favorite team stacks up against the rest. 2, trend analysis. Here, we're comparing a company's ratios over different periods. Is the company getting better at managing inventory? Is its profitability improving over time? Imagine you're looking at the tech sector. A company's revenue growing faster than its assets could indicate it's becoming more efficient. But if net income is growing even faster, it might mean they're cutting costs or benefiting from non-operating gains. Always dig deeper. Is this due to core operations or one-off items? When you're interpreting these ratios, you need to consider several factors. Company goals and strategy. Is the ratio in line with what the company is trying to achieve? Industry norms. How does the ratio compare to the industry average? Economic conditions. What's happening in the broader economy? For cyclical companies, ratios can fluctuate depending on whether the economy is strong or weak. All right, now let's take a deeper dive into the first category we mentioned, activity ratios. So let's talk about activity ratios. You might also hear these called asset utilization ratios or operating efficiency ratios. The whole idea here is to measure how effectively a company is using its assets to generate sales. Think of it like checking the pulse of a company's operational efficiency. The first ratio in this category is the inventory turnover ratio. What does this tell us? Well, it measures how efficiently a company is managing and selling its inventory. A high inventory turnover ratio suggests that inventory is flying off the shelves. Fewer funds are tied up in stock, which is generally a good thing. But be careful, a very high ratio could also mean understocking, which could lead to lost sales. On the flip side, a low turnover ratio might mean overstocking or perhaps preparing for higher demand, like gearing up for a big sale or a potential strike. Next, we have days of inventory on hand, DOH. This metric tells us how many days, on average, inventory is in stock before it's sold. A low DOH indicates efficient inventory management. Goods aren't sitting around collecting dust. But again, too low might mean understocking. Then there's the receivable turnover ratio. A low receivable turnover ratio might indicate inefficiencies, a drop in demand, or even potential earnings manipulations. Ideally, when available, we prefer to use credit sales instead of net sales for this ratio, since credit sales produce the receivables. Following that, we have the days of sales outstanding, DOS. This shows us how long, on average, it takes for a company to collect its receivables. You'll want to compare this to the company's stated credit policy. If their policy is 30 days, but it's taking 60 days to collect, something's not quite right. And if their days of sales outstanding is lower than the industry average, it could mean they have efficient credit and collection processes, or maybe they're losing sales to competitors with more lenient terms. Next up, the payable turnover ratio. This ratio tells us how often a company pays off its suppliers over a period. A high ratio could mean the company isn't making full use of available credit facilities, or it could indicate they're taking advantage of early payment discounts. A low ratio, on the other hand, might suggest they're struggling to make payments on time, or perhaps they're exploiting more lenient supplier terms. To complement that, we have the number of days of payables. This tells us the average number of days a company takes to pay its suppliers. Then there's the working capital turnover ratio. This ratio measures how efficiently a company is using its working capital to generate revenue. A higher ratio indicates greater efficiency, but if this ratio is 0 or negative, well, it's best not to read too much into it. Next is the fixed assets turnover ratio. This ratio tells us how well a company is using its fixed assets, like property and equipment, to generate sales. A higher ratio means better efficiency, while a lower one could indicate underutilization, or maybe that the company has newer assets that haven't been fully depreciated yet. Lastly, we have the total assets turnover ratio. This ratio measures the company's overall efficiency in using its total assets to generate revenue. A higher ratio is a good sign of efficiency. If it's low, it could mean the company's assets are too heavy, sales are sluggish, or maybe they've invested heavily in a plant modernization. All right, folks, those are the key activity ratios to know. Remember, these ratios can tell a story, but it's up to us to read between the lines. And always keep in mind, context is everything. A ratio by itself doesn't mean much without understanding the bigger picture. Liquidity ratios. All right, team, now that we've covered activity ratios and how they tell us about a company's operational efficiency, let's shift gears and talk about liquidity ratios. These ratios are like the company's daily health check. They show us if the company can cover its short-term obligations without breaking a sweat. Think of it like checking the fuel gauge in a car. You want to know how far you can go without needing a refill. So let's start with the cash conversion cycle, CCC, sometimes called the net operating cycle. Now, the 3 C's tells us how long a company's cash is tied up in its operating cycle. Here's the formula. A shorter cash conversion cycle means the company has a higher level of liquidity. Essentially, they're converting assets to cash quickly, which is exactly what we want to see. If a company is good at managing its inventory, collecting receivables fast, and stretching out payables, it will have a short cycle and a strong liquidity position. Next up, we've got the current ratio. A higher current ratio indicates a higher level of liquidity. It means the company can comfortably meet its short-term obligations. But watch out. If this number is too high, it could mean the company is hoarding cash or has lots of unproductive assets. Then there's the quick ratio. The quick ratio is also known as the acid test ratio because it strips out inventory, which might not be as liquid. It's a more conservative measure compared to the current ratio, especially when inventories are illiquid. So if you're wondering how quickly a company can cover its debts without relying on selling inventory, this is the ratio you look at. Now, let's talk about the cash ratio. The cash ratio is the most conservative of all. It only considers the most liquid assets, cash and marketable securities. If things go south, this ratio tells you if the company can meet its obligations in a crisis without having to liquidate anything. Finally, there's the defensive interval ratio. This one is pretty interesting. It tells us how long a company can cover its daily cash expenditures using only its liquid assets. It's like asking, if all income stopped today, how long could the company keep paying its bills? The higher this ratio, the better. So as you can see, liquidity ratios are all about ensuring the company has enough cash or near cash on hand to deal with short-term needs. It's about survival in the short run. All right, moving from short-term survival to long-term stability, let's talk about solvency ratios. While liquidity is about having enough cash on hand to pay bills in the near term, solvency is about the company's ability to sustain itself over the long haul. First, a quick refresher on what we mean by leverage. There are 2 types, operating leverage and financial leverage. Operating leverage arises from using fixed costs in business operations. If sales increase, operating income increases faster because those fixed costs are spread over more sales. But it cuts both ways. If sales drop, operating income drops faster too. Then there's financial leverage, which comes from using debt. This magnifies the effect of changes in earnings before interest and taxes, EBIT, on returns to equity holders. If the return on assets, ROA, exceeds the cost of debt, it can lower the overall cost of capital and boost returns to equity holders. But remember, the greater the debt, the higher the financial risk, especially for companies with unstable cash flows. Now, let's look at some key solvency ratios. The debt to capital ratio. This ratio tells us what percentage of a company's capital is made up of debt. The higher the ratio, the greater the financial risk, and the weaker the solvency position. Next is the debt to assets ratio. This ratio shows the proportion of a company's assets that are financed with debt. Again, a higher ratio means higher financial risk. We also have the debt to equity ratio. This one measures the amount of debt capital relative to equity capital. If this ratio is too high, it signals that the company is heavily reliant on debt financing, which could be risky. The financial leverage ratio, or simply the leverage ratio, is calculated as average total assets divided by average total shareholders' equity. This ratio tells us how much of a company's assets are supported by 1 unit of equity. The higher this ratio, the more debt the company is using. And now let's discuss coverage ratios, which are also crucial for understanding solvency. First up is the interest coverage ratio. This ratio shows how many times a company can cover its interest payments with its operating income EBIT. A higher ratio indicates stronger solvency, meaning the company is more likely to meet its debt obligations. Then there's the fixed charge coverage ratio. This one is similar to the interest coverage ratio, but includes lease payments in both the numerator and the denominator. It provides a more comprehensive view of a company's ability to meet its fixed financial obligations. So, in a nutshell, solvency ratios help us understand a company's long-term sustainability and financial structure. They are crucial when assessing whether a company is over-leveraged or well-positioned to weather financial storms. Got it? Great. Let's move on to profitability ratios next. All right, folks, let's talk about profitability ratios, the ones that really tell us if all the blood, sweat, and tears are paying off. These ratios reflect the profit a company earns during a specific period, showing how effectively it's turning revenue into profit. First up, the gross profit margin. This ratio tells us what percentage of revenue is left after covering the cost of goods sold, COGS. It's all about how well a company can control its production costs and manage pricing strategies. Higher margins mean higher profitability, either due to lower costs or higher prices. Next, we have the operating profit margin. When the operating profit margin is greater than the gross profit margin, it suggests improvements in controlling operating costs, like administrative overheads. Then there's the pre-tax margin. This ratio reflects the impact of leverage and other non-operating income and expenses on a company's profitability. It gives us a snapshot of profitability before taxes kick in. The net profit margin is also key. This ratio measures the overall profitability of a firm after accounting for all expenses, taxes, and interest. It's the bottom line, literally. It shows how well a company is controlling expenses relative to its revenue. Now let's look at return on investment, ROI, profitability ratios. These measure income relative to a company's assets, equity, or total capital. First, the operating return on assets, ROA. This ratio indicates how efficiently a company is using its assets to generate operating profits. The higher the ratio, the better. Next, the standard return on assets. ROA measures the return earned by a company on its assets. A higher ROA indicates that the company is generating more income with its asset base. Another important one is the return on total capital. This ratio measures the profit earned by a company on all of its capital employed. Then we have the return on shareholders' equity, ROE. This ratio tells us how well a company is using equity to generate profits. It's all about return on the shareholders' investment. Lastly, the return on common equity, ROE, focuses specifically on common shareholders. This measures the return earned on common equity only, giving a clearer picture for common shareholders. So there you have it, folks. Profitability ratios are the bread and butter of financial analysis. They help us see how well a company is converting its revenues into profits and how efficiently it's using its resources to generate those profits. Now, we'll dive into the next topic, integrated financial ratio analysis. Let's dive into DuPont analysis, a powerful tool for breaking down return on equity, ROE, into its core components. DuPont analysis allows us to understand the driving factors behind a company's ROE, which is crucial for evaluating how well a company is using its resources to generate profits for its shareholders. It provides insights into a company's efficiency, profitability, and financial leverage. DuPont analysis helps us dissect ROE to see where a company is performing well and where it might need improvement. It's like taking a car apart to see what makes it run, whether it's the engine, the tires, or the fuel. The decomposition reflects ROE as a function of a company's efficiency in generating profits, its operating profitability, its tax burden, and its use of financial leverage. Now, let's break these down. The first formula we look at is for return on assets, ROA. Think of ROA as a two-layer cake. The first layer is profit margin. It tells you how much profit you pocket from each dollar of sales. Higher profit margins, that means you're nailing it with your pricing or keeping costs under control like a pro. The second layer is asset turnover. This one measures how hard your assets are working to churn out sales. More sales per asset dollar, that's the sign of a lean, mean business machine. Now, let's stir in some leverage to whip up return on equity. Leverage is basically how much debt you're using to finance your assets. When you mix ROA with leverage, you get ROE, which shows how well you're using both profits and debt to benefit your shareholders. So let me repeat this again. ROA has two components. Net profit margin, net income over revenue. This tells us how much profit a company generates from its sales. Total asset turnover, revenue divided by average total assets. This shows how efficiently a company uses its assets to generate revenue. These two components combine to form ROA, which gives us an idea of how well a company is using its assets to generate profit. Now, let's move to return on equity, ROE. This equation tells us that ROE is the product of ROA and the leverage ratio, average total assets divided by average total equity. If a company has no leverage, then ROE would equal ROA. However, if the company borrows at a rate lower than the marginal rate it earns on investing that borrowed money, its ROE will increase as leverage increases. Conversely, if the borrowing rate is higher, ROE will decrease. These three components form the backbone of our first three-part model approach. Now, let's break down ROE into its three-component formula. This formula shows that ROE is driven by three parts. 1. Net profit margin, which means profitability. 2. Total asset turnover, efficiency in using assets. 3. Leverage, use of debt to finance assets. Now, we can extend this to a 5-component formula to get even deeper insights. Breaking it down further. Tax burden, net income, divided by EBT, reflects the impact of taxes. A higher value indicates a lower tax rate. Interest burden, EBT, divided by EBIT, shows the effect of interest expenses on profitability. A higher value means lower interest payments, leading to a higher ROE. EBIT margin reflects the operating margin's effect on ROE. Total asset turnover, revenue divided by average total assets, indicates how efficiently assets generate sales. Leverage, average total assets divided by average total equity, shows the degree to which a company is using borrowed money. If you remember these components, you'll have a solid grasp of what's driving a company's ROE. For example, if the tax burden is high, it means the company retains more of its pre-tax profits. A higher interest burden means the company is paying less in interest, which is good for ROE. The EBIT margin gives us a view of operational efficiency. Keep in mind that these margin can be further broken down into a non-operating component, EBIT divided by operating income, and an operating component, operating income divided by revenue. Each part helps us see exactly where value is being added or lost within the company. Understanding these components allows us to pinpoint why a company's ROE is high or low. It's about seeing beyond the surface number and understanding the underlying factors at play. Now that we've dissected DuPont analysis, let's move on to industry-specific financial ratios. Different industries have unique characteristics and risks, so it's important to use specialized ratios that align with each sector. For measuring business risk, we use the coefficients of variation. These ratios help us understand the volatility of a firm's performance metrics, which is critical for assessing risk. For the financial sector, key ratios include capital adequacy, measures the capital a bank holds against its risk-weighted assets. Monetary reserve requirements, cash reserve ratio, calculated as reserves held at a central bank divided by specified deposit liabilities. Liquidity asset requirement measures liquid assets as a percentage of specified deposit liabilities. Net interest margin represents net interest income as a percentage of total interest earning assets. Retail ratios are also essential. Same or comparable store sales reflects revenue growth year over year for stores open in both periods. Sales per square meter or foot measures revenue generated per unit of retail space. For service companies, key ratios include revenue per employee, shows how efficiently a company is generating revenue per employee. Net income per employee indicates how much net income is generated per employee. For the hotel industry, we use average daily rate, ADR, room revenue divided by the number of rooms sold. Occupancy rate, the number of rooms sold divided by the number of rooms available. These industry-specific ratios provide a more nuanced view of performance and risk, tailored to the unique characteristics of different sectors. Lastly, let's talk about model building and forecasting. Using ratio analysis along with other techniques, we can construct pro forma financial statements. These are based on sales growth forecasts and assumptions about the relationship between changes in key income statement and balance sheet items. There are several techniques of forecasting to keep in mind. First is sensitivity analysis, also known as what-if analysis. It shows the effects of changes in one input variable at a time and provides a range of possible outcomes. Second is scenario analysis. Examines several possible situations like worst case, base case, or best case, and provides a range of outcomes based on simultaneous changes in key financial variables. Third is simulation. This is an advanced form of scenario analysis that uses a computer to make random choices for each variable input. Each possible outcome is assigned a predetermined probability, resulting in a probability distribution. This helps estimate risky outcomes and calculate expected returns and standard deviations. Understanding these techniques helps in building robust financial models that can accommodate various scenarios, making them invaluable for planning and decision making. This helps in constructing pro forma financial statements, which are crucial for decision making. And there you have it, folks, a full walkthrough of financial analysis techniques from start to finish. This stuff is critical for your CFA exam and your future career. Remember, practice is key, so dive into those examples in the CFA Institute's curriculum and FinQuiz question bank and get comfortable with the numbers. Happy studying, and see you in the next lecture.